strategist, the person to help us dive deep into that discussion. Chris Robinson joining us this morning from TJM Institutional Services. Chris, welcome. Let's begin with your thoughts on the Fed. Alex was breaking it down earlier in the show, and he said pretty much not to expect much in terms of a rate hike, but he's looking forward to the question and answer session, the conference, Fed Chair Jerome's Q&A after, in terms of what to expect further on as we look forward into the end of the year.
Yeah, I think if you are tea leaf reader and trying to figure out what these guys are going to do, it seems like people are expecting, hawkish talk, but maybe holding off on one more. Although they've already hiked so much, 11 times here, I think that even they're like, well, let's see what happens here towards the end of the year. And you continue to see what's the number one metric that I think that they're focusing on is the employment numbers. And the last employment number, it looked good, but then if you dug into it deeper, it was part-time versus full-time. So I think that they may be getting some traction into really what they want to see, which is, it seems to be that all their goal is, before they really back off, would be to be a softening labor market, and I think they're waiting for that. But at the end of the day, I'm a bond trader, and you look at the charts. We had that correction after Mr. Ackman, told everybody to go over to shorts. I think for all intents and purposes, that's going to be sort of the level now that we're going to be looking at as we move ahead. So take a look at that 10-year. It's bounced and it's in a little congestion period here. If you look at the handle right now, look at this 106 level. I think we may hang out here between now and the end of the year and see if the Fed is done doing what they're doing. But big picture, pull up that chart and just, you can see what the bond market has already done. So a lot of the Fed's work has been done by the bond market.
Chris, I've got the bonds on the left, I've got the 10-year on the right here, and to your point, we have seen quite the acceleration recently, so it might be that we do form a bit of a range here. We're looking at well below the middle of this 108 handle, the highs that we saw in the middle of October, and those recent lows that we saw down around 105.10. I want to point to the fact that throughout this process, we've seen rates on the move higher, right? And this is a tough trajectory to maintain, this run-up we've seen here in the magnitude of, again, the 10-year on the right here, in this case, the 30-year on the left, 30-year to 5.15 last week, the 10-year as we begin the week just below 5%. But, this is really starting to weigh on the indices, it seems like, here. And we were calling this kind of a levitation act, sort of wondering how long could the bulls continue to hold stocks at these upper levels here if we continue to see rates rise here at the to the extent they have here. And it's starting to catch up with them at this point, it seems like.
Yeah. Well, you got to remember, this time last year, we were at a 3-year low, and the S&P hit 3502. It was a 27% correction off the all-time high. So, and people were, it's bear market, bear market. Boy, a lot of smart people got left in the dust, because then we turned around and, rallied 1,100 points in the S&P, almost back. We just made was it an 18-month high, 22-month high,
well, Chris,
in July?
Some of that strength, some of that rally came from stocks, right? We saw tech stocks, which did really well, but also some of the data was pretty strong, very supportive of that move up.
And then now we've had, it's a 10% correction. If you get really want to be a stickler, it's from the top to the bottom, it's 12. People started looking at, what sort of a retracement was that? That was about a 38% pullback. The next level people start to look at is halfway back. Halfway back of what? Of that rally from last October to July. So when there's no fundamental story out there, or people are searching about for, is the Fed done? Are we done with rates? These technical levels become magnets.
Yeah.
And they don't always work, but
well, we were just talking about that in terms of crude. When the fundamentals get a little out of whack, ultimately you can lean on the technicals in these levels. The areas that the market's paused in the past and proven are significant areas based on price.
Yeah. It's very odd. I mean, especially if you've been in the business for 25 or 30 years. The last couple of years have been so technical. When there's uncertainty, and I think it's just the impact of the algos and the computerized trading. There's a lot of black box trading that goes on here. There's not a lot of people, sitting there like gunslingers saying, all right, sell 1,000 spoos here, buy 1,000 spoos there. It's very, very pre-programmed, and it's good or bad. But I have noticed that in the past year and a half, where that's been the issue. So very technical. Also what's going on now? Well, it's the end of the month. We just got into the final quarter, and of course October is rife with stories about we're going to have the stock market correction. We had one last year at this time.
Seems like with price into the end of the month, you get kind of price activity. It doesn't necessarily have much rhyme or reason. So potentially look for some more randomness as we establish this little bit of a range here. Chris, talk to us about how it's not just the Fed this week. We also have Bank of Japan and the Bank of England to keep an eye on as well.
Tell you, if you want to look at one thing, watch the yen. If the yen takes out that old low, it's going to be, we're going back to 1990 again. So a couple times here now, the Japanese central bank has stepped in to try to, stop to stem the tide.
They haven't had much luck here. We've got the chart ready to pull up here. I mean, you can see the well-defined trajectory, the trend lower we've seen.
And you can see the days where we spike up. That's where the Fed, that's where the central bank steps in and tries to do something.
Yeah.
Like I said, at the end of the day, price is what matters to me, not anything else. So we'll see. I would not be surprised if we went back down and tested that 66 level again.
Okay.
Again, why? Because in absence of a fundamental story, you tend to have interest go to those old lows. We'll retest them and see them. You see them in a lot of markets. You're seeing it right now, and you mentioned gold. Gold's above 2,000, so it's a psychological level. You're even seeing it in other things like Bitcoin. Once Bitcoin got above 30,000, you have a lot of more interest. So for better or for worse, the technicals seem to be having an overriding influence in not only the bond market but everything. Until we get a fundamental story, and to see that the crude oil market, sitting here under 84, I think if, a betting person, if 2 weeks ago I had said, Exhibit A is going to happen in the Mideast, you'd be like, I need all the calls I can get. And the fact that it did not play out, so you have people that get out of that position as well.
We're looking at the yen here just to kind of further and provide a little bit of a visual to your point here in terms of this significant area here. And this kind of feeds into what we've been talking about for a while, how our markets have seen a lot of intraday volatility, but not a lot of follow through on that longer term trend. But another instance here, the Japanese yen, of a market that's kind of teetering right on the edge of seeing some big moves here if we were to continue lower here. We appreciate you bringing that to our attention here, and maybe the BOJ's decision, the bigger one to watch relative to the BOE, FOMC, and what we're going to hear from the Bank of Japan. Chris Robinson joining us this morning from TGM Institutional Services.